And the other thing is we're going to talk about the TAM, SAM, and SUM, and why it's important, how to come up with TAM, SAM, and SUM. So you understand, just generally like the market size of the companies that you're assessing. Okay, cool. Any questions real quick? Did everyone get a chance to pair up for the Grubhub homework? No? Okay, so figure it out, guys. Okay, Puya? Oh, you have a question, or did you say you were able to pair up?
No, just a pair up.
Oh, okay. Good. You're gonna need one other teammate for the BCPE project. Yeah, try to get to know each other. Too bad this wasn't in person. Would have been a little bit easier, but nonetheless, welcome to the virtual world. Okay, so Grubhub. So let's just talk about some basic concepts. I mean, you have the debt to equity ratio, the quick ratio, certain profitability formulas that were mentioned, right? And I guess like the first thing, we could talk about is, what is the importance of the quick ratio, debt to equity ratio, and profit margin ratio? Does anyone want to answer this question? Any brave souls?
Sure.
Well, let's go back to this. Like what is the importance of a debt to equity ratio? What does it show you?
Essentially, if you're able to pay debt.
Yeah, but it also shows you basically the breakdown, right? So let's just think about maybe perhaps like in a I guess like you can think about this in a publicly traded company, right? Your ability to pay debt and how much leverage you have to see that how much risk that you have, but also in the process of acquiring or growing as a company, you understand how that capital is supported, whether it's through debt and equity, right? What about profit margin ratio? What is the importance of that?
I mean, it tells you your profitability per how much you're spending to how much you're receiving in profit. So it tells you.
Yeah, just like the financial health of the company, right? What are some pros and cons about these ratios then? That was a good exercise. Like what are some pros and cons about these ratios? When let's say you're comparing for example, like Nike's profitability ratio, and you're comparing it to Zoom. What's not good about it?
They're not even in the same industry.
Right. So the comparisons are completely off, right? It doesn't make sense to compare Nike's profitability or Zoom, different stages of the company's life cycle, different industries, common sense, right? How about in terms of like the debt to equity ratio? Does the debt to equity ratio fluctuate along with the stock price? Like, let's say all of a sudden Tesla doubles, right? In terms of its stock price, like which it did, right? Like every single month, it seemed like last year. Was the debt to equity ratio changing on a day-to-day basis?
I think so, because
It shouldn't.
equity increases or not. I mean, it's the same amount of stocks, but
Let's assume no distribution of additional stock.
okay.
Would it change? Does it not change? How does the market cap affect the debt to equity ratio?
I think it shouldn't change because the equity that we are like looking for, it's just book value. So yeah, it shouldn't change day-to-day basis.
How many say it changes? How many say it doesn't change? Doesn't change? Yep, that is correct. So it's based off of historicals, just like Priya mentioned. So book value in essence, right? So all of a sudden it's not going to change, go up and down on a constant basis. So all these ratios are in essence on historicals, right? Now, if like new equity is raised and new shares are distributed, like that will definitely impact it. Just like if you raise more debt or paid off more debt, that's going to affect it the next time you have like another 10K or 10Q that comes out. Market cap. What is market cap, guys? What's the formula for market cap?
Price times the number of stocks. So
Price
shares.
times number of stocks.
Yes.
Okay, good. And how is that different from book value?
The book value is what's the assets on the balance sheet, so it won't change even though the stock price changes.
Mm-hmm. Exactly. What's normally higher? Is it book value or
Market cap is usually higher because it takes into consideration future prospects like growth and intangible resources.
mm-hmm. Yep, exactly. So yeah, this was a good review. So Growhub review. So these are just some of the core concepts. So market cap does not affect the debt to equity ratio. Understand why market cap is always greater. It's crazy because sometimes my undergrad students really struggle just with the market cap concept, especially for the younger students. But I guess like a couple of you guys have experience in finance, so that's not a concern. But if you have any questions about this, let me know. But as Lai mentioned, market cap always takes into account future prospect of growth, and then you're buying these shares at the publicly traded market. So you're basically able to, since stockholders are anticipating future growth, it's almost always higher. Other key concepts, profit margins, quick ratio, all these, leverage ratios. I guess like the core concept is that like you're trying to assess the financial health of a company, but it is relative to companies within that particular industry. So just kind of like the exercise that we did yesterday, when you're trying to find comparables, but there's a completely new industry or an industry that's very different from the current one that you're trying to assess. That's where you have to kind of assume a lot of things and build out your model to make it fit in. So that's where it gets like really tricky when things aren't very difficult to compare. So let's skip this one. I think you guys have a good understanding of it. So was everyone able to find the book value of Grubhub and then understand why there's a difference between market cap and then the book value? I think it was one of the first questions there. Yeah. Okay. As a quick review, let me see here. I'll just pull this up. Okay, so I'll just go through this really quickly. And in terms of, I guess like the next question was, Grubhub's net earnings for 2016, was it the same from cash from operating activities? Why or why not? Were you guys all able to find the net income and then cash flow from operating activities? Why the difference? Where did you find it? Puya.
So cash from operating is in cash flow statement, and
Mhm.
net income obviously is in statement of operation. And they're different because the revenue that the company is generating, it's not always cash, and there are and also there are costs and other expenses that they're not like cash materials, like the what they say, depreciation and amortization, and we have like payables, we have receivables, so they are not like always included with cash.
Yeah. So this is a great example, right? You see the 8,921. This is a non-cash expense, right? So hence the difference between, you know, cash flow from operations and net income. So really funny story, guys. Back in the you know, like early 1900s, there's like no such thing as like depreciation in accounting. Like depreciation was not invented in the art of accounting. So what happened was all these railroad companies started to like go bankrupt because then they had to spend all this money for maintaining like equipment, you know, all the PP&E, right? But because they're not accounting for depreciation, like all these financial analysts, like back in the day, or accountants, thought like, wow, these companies are really, you know, really healthy. So they were just completely misguided, right, in terms of the financial health of the company. So once they started to add, you know, depreciation, like in the early 1900s, like that's when they realized, oh, okay, we need to start adding this to really assess the health of the company. So this is a really funny thing that happened back in the day. What are some different forms of depreciation? You guys remember?
There's the straight line depreciation, which is consistent each year. And then there's like the double where it charges, or I can't remember the
Yeah, it's
specific
like
name,
but
but like it charges,
yeah, go ahead.
it charges double the first year and then incrementally goes less the year after.
Yeah. What's interesting, something like depreciation could be very subjective. So in those instances, you want to just look through the numbers very carefully for any forms of manipulation. So oftentimes you might see changes in the footnotes, sometimes just in the general like overview of the company if they make any material changes. There's all these things that you can like really investigate in the 10K and 10Q to see you know, any kind of material impact that could have happened. Grubhub's balance sheet equation. I think this is too easy for you guys. This is pretty straightforward stuff. You know, what was retained earnings of Grubhub? Anyone want to get this one?
It was just under the SC on the balance sheet where they say what the retained earnings were. I don't have that number.
Yeah, pretty easy to find, right, under the balance sheet. So if you're able to get this question right, good for you. Let's go to the next question. Grubhub, did they pay dividends? Yes or no? And if not, why? No, right? Why wouldn't they pay dividends? And you know, when should, more importantly, like when should companies you know, pay dividends?
I think they wanted to invest more on their business and like acquisite like some companies and grow their business. But I believe they should pay dividends because they're holding a lot of cash and so they're not doing anything with it. So they
Oh
should
yeah, when
at least pay a little. Yeah.
yeah. Do you guys, Priya, do you remember any like major company in the last, you know, 6 or 7 years that decided to pay dividend and it was like, you know, they had a lot of cash and then it was like on the news a lot when they decided to pay dividends? Do you remember a company that was like that?
Apple, you mean?
Yeah.
Yeah.
So like to Priya's point, Apple was hoarding cash for so many years. I think around like 2014 or 2015, they decided to pay dividends. And because they decided to pay dividends, it was on the news a lot, and a lot of financial analysts we're debating, you know, if this is good for the company or not, because usually, you know, when you pay dividends, it signals, right, potential future of the company. So I guess like if you're an investor and you see like a high growth company that's growing consistently 30% year over year, and all of a sudden they decide to pay dividends, what red flags come to your mind?
It's
Maybe
kind
they're
of maturity.
Signal of maturity, right? And why is that?
Because there is no area, there is no room to like progress further. There is no room to expand more. There is no like possible investment, like opportunity to invest in, probably.
Right. So it's basically saying like, hey, I'm out of ideas to grow the company. Let me just pay my shareholders back, right? So with that note, I mean, it's, you know, it's maybe Grubhub should pay dividends, but if I were an investor, right, if I came in particular early, I'd be like, I would love to talk to the founders and like, guys, like, can't you guys acquire something or use that cash for something? You know, I'd probably get really frustrated. But also, I could imagine companies trying to signal, right, stability, or trying to signal that they're more, focused on growth. So there's always maybe, you know, there's always an underlying reason companies do something. You know, is it really because they want to seem like, they're focused on growth, or are they trying to signal something, right? Or are they trying to, or is it really the case, or are they trying to signal something, right? So it's always like a two-part investigation that you have to do, and things that you have to consider. Now, what's really interesting in the private market as well, there's a lot of business owners. Sometimes they raise from friends and family. So I know some of you guys want to do lifestyle businesses, and then basically when you create like a term sheet, right? Let's say you bring in your uncle, your aunt, and then a friend's dad or something like that to invest. In the term sheet, if you hit certain amount of revenue and profitability, you might have to agree that you're willing to pay a certain amount of dividends, right? Or you reach a certain level of stability in your company, and you're no longer focused on growth, you're just focused on profitability, then you might switch this and distribute dividends and whatnot. So it's not just the public markets that distribute dividends. You could also be used as a mechanism, right, to keep your shareholders happy and sustain your lifestyle and supplement your wages, right, on top of supplement your wages. So you get a bonus on top of the wages that you pay yourself. Does that make sense? Okay. So, this is just what we discussed in terms of like retained earnings, etc. Why, when, and why should a company pay dividends? Very important. Dividends are corporate earnings that companies pass on to their shareholders. It sends a message. So that was basically the case back in 2013, 2014, when Apple decided to pay dividends. It was a huge controversy because Apple was, multi-billion-dollar company. I don't think they were a trillion at the time. I can't remember exactly, but they're, in terms of market cap, they're probably like a top 3, top 5 company. And they started to, pay dividends, and everyone's like, okay, is this the end of Apple? Are they going to go? Are they declining? Is it going to be worth? Is it going to continue to grow? So that's a challenge. I mean, it's already challenging to grow at that size you're in. But also, if you're running a company from that angle, I guess it's also very difficult because you don't want to signal anything negative. But yeah, Apple stock, as you guys all know, it's been doing fine. I think the last time I checked, it was like trading at 140 and market cap of maybe 2 trillion. Not sure, but probably somewhere around there. Okay. So is it smart for startups to pay dividends?
No,
Why, Logan?
they should be putting that money back into the company.
Yeah, you have no market share. You're growing. You're probably not even profitable, right? So it probably makes no sense whatsoever you're like raising money to pay your investors back to the same investors that you raise money from. Makes no sense, right? Simple concept. Yeah, mature firms, they could probably increase their value by reinvesting their earnings. You know, so I guess like a lot of companies, right, that are very, very stable, you know, dividends are a big thing because certain shareholders really like that passive income. So that's, you know, that's another important thing as well. Okay, let's see here. What else? So how much cash and cash equivalents does Grubhub have at December 31st, 2016? Is this same amount or greater than? Then you can, you know, decipher the major uses and sources of cash. And I guess like, you know, to Puya's point, could also see like how effective they use their cash. Like, does it make sense to pay dividends, or does it make sense to, you know, reinvest? Should they acquire businesses? You know, those are just some of the things that you want to look for to see how efficient they are in terms of managing cash flow. Any questions about the Grubhub homework? No? Okay. I'll post the answer key later today. And then yeah, if you have any questions about it, just let me know. So hopefully it was a nice little review for you guys. Okay, so let's talk about TAM, SAM, and SOM. Did everyone get a chance to watch the videos?
The Uber one still wasn't working, but aside from that,
Oh, okay. Yeah, my apologies. I totally forgot. I did post the Uber one this morning. But yeah, we could talk about it in just a second. Okay. Does anyone remember what the difference is between a top-down approach and a bottom-up approach? How would
So-
like yeah, good.
So with the top down, they're looking at the industry as a whole and then narrowing it down. But with bottoms up, you're looking more at your customer, your market, like your customers that you are able to acquire, and for your particular that your product and or service is trying to sell to.
Mm-hmm. Good. Yeah, so this is a, you know, very simple structure. So as Lai was mentioning, you know, top-down approach, you're starting from just generally really big strokes, right? Like you're looking at the macro economy, then you're looking at the competitive landscape, then you're looking at, you know, addressability. What are some factors you would consider, right, as you're going from really big to small? So what industries do you guys want to talk about, for example? Let's go back to sim number one, the first sim that you guys talked about. So if you're taking a top-down approach, first of all, it's ed tech, right? And then how would you reduce it? Because it's not entirely, hold on, let me close my window. Okay, so if you're starting with ed tech, right? You know that that product is not entirely ed tech. How do you reduce the size? What are some factors that you would consider?
Whether it's for-profit or nonprofit school.
Okay, that's a good one. Yeah, that's okay. For profit, nonprofit. What's another one? How about geography? Would that be a factor?
yes.
Okay, so maybe like just, and how would you narrow that, Logan?
Trying to hit the East Coast, you're trying to hit the West Coast, you're trying to get the Midwest, you're trying to go for the South. Where are you trying to hit? Where the market's at?
Okay, maybe this company, right, needs a lot of face-to-face time, and you're limited to where you're geographically located. But maybe it's a software that's really sold virtually. It doesn't really matter, and all you need to make sure is the client speaks English. That's all that matters, maybe potentially. So you can narrow this by geography. What's another thing that you can limit this by? How about in terms of like the product? Can you be more specific about the product? Because ed tech could mean anything. It could mean, niche software helping students with disabilities, right? It could be general LMS software, right? But remember, what did that what did that company do for that anonymized SIM software company? What did they do?
They essentially created a CRM, but for schools.
It's a CRM for schools, right? So you could probably further limit this to the total revenue size, right? In terms of, this how much revenue is generated just for the CRM within the edtech space, right? So you're narrowing it from edtech all the way to CRMs within edtech, and then you're narrowing it further, right, based on geography, right? And then also you're narrowing it further based on schools, for-profit, nonprofit, right? Do you guys follow? And then you can potentially arrive at a number that you could be like, oh, okay, this is manageable. So that's basically a top-down approach. So let's go backwards on that. If you're doing a bottom-up approach, where would you start?
The actual metrics provided by a company.
Actual metrics such as
Financial information, so and anything on the balance sheet, income statement.
and then you're almost there, Logan. What's that one thing that you really need to know?
Their market analytics, like their
No,
oh, all
I'm
right.
getting cold. Anyone want to help Logan? He's almost there.
Customers? The
Customers, yes,
that
but
we already
what
have?
about the customers you need to know, Puya? What about the customers you need to know? It is customers. You're like right there.
Is it target customers?
No, well, yes, you could, but price of the product, guys. You need to know the price of the product. What are you going to multiply the number of customers with? So that's probably the first thing that you want to target, right? Number of customers they have, number of like the price of the product. So what's interesting about a bottom up approach is that like based on the price that you're charging, this could change drastically. Now, it doesn't necessarily mean your price specifically. It means probably like the average price of similar products in that space multiplied by the number of customers. Then you expand from geography, then you expand based off of, I guess, like, countries and whatnot, but then you're building it out for that specific niche. So instead of canceling, it just becomes additive because you're starting from the other end of the spectrum. So those are two different approaches. Now, I do generally prefer the the top-down approach because of its simplicity. And normally, there's more than one way to arrive at similar answers. So there's no right or wrong. But regardless of whether you're in PE, VC, or starting your own lifestyle business, you want to know how big the market opportunity is, right? So, for example, like what we concluded from that deal number one, or internally it's called deal number one. The size of the market was way too small because at best, it was only $1 billion industry. So even if we captured, 10% of the market, which is already really hard, the maximum we can get is 100 million a year, which is not bad. But it's like normally, when you're pitching to VCs, for a startup, you kind of assume under the assumption of 1%, right? So then it's like, all right, if you make 10 million a year, I mean, this company is at best going to be worth like 50 million. Like that's it. So I'm buying it for 15. It's only like a 3x move, which is not as exciting. I mean, it is exciting, but it's like not that exciting. There's better opportunities, and you're trying to compare apples to apples. So one of the things that we did for DealFlix when we were doing the movie ticketing space, the size of the market was about $10 billion. And can anyone try to guess like the size of the market in terms of like concessions, popcorn, soda, and candy in the movie industry, just in the US? Ticketing is 10 billion, right? How much do you guys think popcorn and soda and concession sales are?
I'm gonna guess half of that. So 5 billion.
Pretty close. It was $10 billion. It was an equal $10 billion. So it was just that in itself was 20 billion. And then globally, it was 40 billion, right? If you had a ticketing concession. So that was baked into our pitch. I remember like one time we did research on pizza delivery, like just on the pizza delivery industry. Does anyone want to take a wild guess on how big that market size is? It was about $9 billion. Incredibly big. So we were thinking, okay, if you just built a pizza delivery app, just like, just a killer app on pizza delivery, like what kind of pepperoni, bacon, is it Canadian bacon or just normal bacon? How many anchovies do you want? Like if you wanted to make it very, very specific, in theory, it has the market size to get people really, really excited, which is really funny. Now, when you're looking at certain industries, you want to look into certain characteristics, what we're going to talk about a little bit later, right? You want to look at, is the market consolidating? Is there, enough fragmentation, right? You don't want to go into, I'll just stick with movies, like the movie ticketing space. But let's say you're trying to start a movie theater, not like a Fandango or like a company that I did. But if it's very long tailed with very heavy concentration with, for example, like AMC Regal Cinemark, which dominates about 60% of the revenue in the industry, like you probably don't want to start a movie theater unless it's just a, labor of passion, right? Labor of love, right? In that case, yeah, maybe. But if you're trying to grow, there's no way you're going to catch up to some of these Goliaths, right? Which make it like really, really difficult. So when investors think about these things, those are some of the things that they look at, and you really need to be able to answer those questions. Yeah, anytime you're submitting, any kind of like TAM, SAM, and SUM in a pitch deck or your business plan, if you're trying to get a loan and whatnot, always make sure to, add your assumptions in there. So in terms of like generating revenue, I'm sorry, in terms of creating TAM, SAM, and SUM, it's not always based off of the revenue that's generated. You could also do this by the number of inventory that's sold, right? Or the number of SKUs sold in the market. So this is a pretty simple example of creating a TAM, SAM, and SUM of Airbnb. So you're taking in the number of trips that are booked, right? And then you're segmenting this for budget and online trips, and then you're taking, right, what Airbnb can Airbnb can potentially book. So does anyone remember the difference between TAM, SAM, and SUM? Yeah, Logan, what's the difference?
So TAM was the total available market, SAM was the served available market, and then SUM, at least from the video that we got, I'm assuming it means target market, but I don't know the exact SOM.
Yeah,
Definitely.
Can anyone help Logan? He has most of it.
It's serviceable obtainable market, so it's like the share.
Yeah, thanks, Persia. Yeah, so the amount that's realistically attainable, right? So oftentimes in a VC pitch, by default, I don't know why, but people decide to go for 1%. Because normally you'll do projections like the first 2-3 years. And that's, I think, and oftentimes a very optimistic scenario. But when you're breaking down TAM, SAM, and SUM, you don't necessarily have to break it down by dollar figures. it could be based off of how many units you're selling. So this is a really good example of how it's broken down here. And when would you probably use, I guess, number of units sold versus, you know, using actual like dollar figures? What are some pros and cons of this?
So if you're basing how many units you're actually going to sell on the TAM or the total available market, you're going to be a little misled, you know, because it's the market as a whole. And then you have the served available market, which I think that's where your units and dollars come into play, if I'm not mistaken. And then finally, for the serviceable obtainable market, that's you know, that's where the projections are going to be done. How much are you going to sell in 1 to 3, maybe more years?
Yeah. Well, so Logan, yeah, so those are good points. But like, let's say you're a VC, right, or an angel investor, and you're trying to make a decision between like 5 different startups, right? And oftentimes VCs and angels only spend maybe 30 seconds per pitch deck. Like they're just probably gonna flip through this. Like, what? Now, if they're flipping through it really quickly, and then, you know, and for whatever reason, doing it one way versus the other is more favorable to you, it could work in your favor. But generally speaking, they want a very simple apples to apples comparison. So if you're the only one, like, you know, having like units or SKUs or inventory, like whatever that metrics is, it probably is there's a good chance it's probably a disadvantage to you. So I've rarely seen pitch decks that are using number of units sold. Like almost by default, you should try to go with dollar figures if you can. Now, if you don't really know the pricing structure yet, and you're very, very early, you know, it could work potentially. But you know, that's my 2 cents. By the way, if you guys get a chance, check out Airbnb's pitch deck. It's like one of my favorites of all time. The simplicity of it barely uses any words. I mean, it's like, yeah, it's like maybe like 8 words per slide. It's just done really, really, really good. So this was actually from the Airbnb slide. Okay, so let's see here.
Did you upload that file for an
This one?
Airbnb?
This slide?
Yeah.
No, not yet. Not yet.
Okay.
Oh, you guys want to see the pitch deck? Yeah, I'll upload it. Let me just write that down. Okay, let's do another like really simple exercise. So let's say there is a software. Oh, I have a great idea. So let's say there is let's look at a company real quick. So let's hypothetically say, oh, someone mentioned, oh, thanks, Logan. Appreciate that. That was quick. Okay, so let's say there's a company that wants to buy this business, right? So what this company does is that they do kind of like a sales team as a service, I like to say. So they're bringing in a sales team. They bring in people that are able to create all this like lead gen, close deals. They bring in a temporary senior vice president of sales to boost sales for like 3 months, 6 months, like a sales SWAT team, and then they leave, right? And the beauty of this service is that when it comes to sales, there's a lot of seasonality to sales, and because of that structure, you know, when we look at this business, we want to build something that's significantly much more sustainable. So the debate that, you know, you could potentially have is that, okay, how do we create a software off of the services that they do? Now, if you could convert a professional services business into a software business, like, you can make a lot of money, right? So what we're trying to do is investigate the size of like CRM tools in general, like CRM tools for sales, right? And if you were to start doing that exercise, taking a top-down approach, what would be the first thing that you look at? If you're looking at sales software CRM tools. Like, think of this as potentially like the next Salesforce that you're trying to build for companies such as this. So I think the first thing you'd probably do is, you'd probably narrow it down geographically. You'll probably have a very easy time figuring out, the general size of the industry, right? Because you could probably just look up like sales CRM tools. Obviously, there's other, platforms like Salesforce, HubSpot, Pipedrive. There's all these competitors in the market, but you want to just start with, okay, what is the aggregate size, right, of, a new CRM tool that you could probably bring into the market. And the second thing is you probably want to narrow this down by, regions that speak English to have a realistic, I guess, attainable goal that you can narrow down the TAM to get an assessment, right, of the company's potential. What are other things that you would want to consider? What about companies? Would you want to look at how many companies are in the space? And okay, and then you probably want to, what about like product differentiation? Would you consider that as well? What about, in terms of like the product, like what would you look for, to see, I guess, like how, like let's just take a look at like companies, for example, like Pipedrive. So these are just some of the examples that, you might be able to see between, like there's companies like Monday.com, there's Pipedrive, there's Salesforce, right? So what's interesting about this space is that they probably don't have legacy software. This is probably all cloud-based, right? So you want to probably narrow it down to cloud-based software and then see if it trims down, but it probably won't, because all these products are usually cloud-based software. You probably also, want to see like what the price structure is, right? Do they work off of, a SaaS model? Is it just kind of like a, one-time license fee, perhaps if it's not converted to cloud? So you're going to find all these characteristics to try to trim this down to find, the ultimate size, right, of the CRM. So here's a quick example here of what we discussed. And this is a software CRM. We took a top-down approach and then we broke it down, right, based off of certain characteristics, like are they speaking English, are they not speaking English? All these different examples you can look through. Now, on the reverse, right, if you wanted to take a bottom-up approach, this is what it could potentially look like as well. So this approach, you took an example of, okay, so total addressable market, basically, this example is saying like, we're looking at 600 million users of Excel on a daily basis across 60 million corporations. And then how many people are using a cloud-based CRM, right? And then 20 million using cloud-based accounting users. And then you're taking a certain percentage to break down what is realistically attainable, right? So service addressable market, you're looking at 1% of Excel users, you're adding that with 2% of CRM users, 10% using, some kind of, accounting software. And then within this framework, you're taking 1% of users in SAM, which fit target groups and regions. Now, once you attain the SOM number, how would you convert this into dollar figures? What would you probably do? Any guesses?
Like you said, use the price of
Yeah,
like
just
the,
what you would do is exactly for sure. So you'd probably take the average price, maybe even do some customer surveys, maybe just looking at pricing models in various websites and come with the realistic price. Now, sometimes a lot of products will have, the light version, for example, the I guess like the premium version, the premium plus. In those cases, you'll take the average price of the software and then multiply it here to just come up with your Samsung TAM, SAM, and SOM. Pretty straightforward. These are some examples of an exercise that we did with some of my former students in terms of coming with the size of edtech software. So let me just show you which company this is. Just give me 1 second. Okay. So let's take a look at this. It's called Advanced Business Learning Software, or just it's called Advanced Business Learning, and they have a software to teach. Just take a look at the video real quick. So it looks like this is just one of their locations. Some pictures here. They have an academy. It looks like a lot of this stuff is like on-site based, right? You could see the average prices here for their courses. You could look at potential partnered schools, where it looks like they do partner with high schools, get all these certificates. Okay. Are you guys getting a good feel for what kind of business this is? Just kind of scoping around. So if you were to kind of outline, right, just on basically what you see here, how would you find the TAM, SAM, and SOM? Like what approach would you take? Like any brave volunteers?
For the total available market, I'm assuming that this is the business education market.
Business education, right?
Which,
And
I mean,
then how would you separate the products? Like what comes to mind? Is it on-site, off-site? Is it cloud-based? What are your thoughts, Logan?
I mean, this looks like an on-site school, right? At least they had the centers where you could, go in and learn. So I would
Do you think
imagine
it's solely on-site?
probably not. I mean, I haven't looked around on their website to
Mhm.
know, but I would assume that there's some online training as well.
Right. So if you could figure out so they have a webinar here, right? So good chance that it's online and offline, right? So Logan, based off of that, you'd probably have to do maybe 2 separate industries if you wanted to break it down. Or if you want to just get a really quick idea, you could probably just be really lazy about it, right? And just look at, business training markets or something like that. Then you can look at the product and see if it's viable for, I guess, is it just viable for high schools? Is it viable for any school? You could probably break it down further. What are some other characteristics that you guys would look into to try to break down TAM, SAM, and SOM? What about the prices? Did the company have the prices available?
No, I think they had other websites, right?
They did have some prices, so maybe I'm going too fast, but they had like, IT services here, right? Give you an idea of what kind of products that they sell and what kind of trainings that they offer. You could browse all the courses here.
Oh, my bad. I thought that was like the different websites giving different courses.
Oh, okay. I don't know. Maybe I'm wrong. I internalized it as the
No,
course.
yours is definitely more correct. I was just looking at real fast. So.
Okay, then how dare you challenge me? I'm just kidding. Okay, so these are the courses, right? Available. So you get a good sense, right? Do you guys kind of feel like you got a good sense of how you want to structure your research? So you could take all these different angles. Like for me, I would probably break it down by what percentage of this is on site versus how much of this is online, right? Cloud-based. And then I'd probably run two different TAMs, right? And then combine those at the end. So I'll do TAM, SAM, and SOM, and then combine it at the end. That's how I would approach it, right? But there's no right or wrong answer. Like you're the entrepreneur or you're the investor. You have to be able to think independently and how you assess it. And you have to back into those assumptions. So we did this exercise, I think it was last quarter or the quarter before. And these are all the different examples that we had in terms of TAM, SAM, and SOM. So someone took the number of customers, total customers in the market, then, multiplied it by price, right? It's actually funny, like some of these students actually called the companies to find out like more accurate prices. And then they took out what was addressable. You could see, this had a bunch of footnotes, right? So they took data from Fortune and Gartner's IT budget. So I think the student like focused on IT training and leadership professional development programs. So serving Fortune 1000 customers. So he or she just took out the high school stuff. I don't know what happened there, but that's what he or she decided to do. So she was able to come up with a TAM of $3.7 billion, roughly. This is another example, right? ABL. So let's see what this person did. I took into account the supply and demand of the total cybersecurity. So he or she defined this as a cybersecurity thing in a specific region. So he or she limited this just for the United States. And I guess that makes sense because this is SAM, service obtainable market. And then, it was like geography was like a big factor. And then she looked at number of people that are serviceable within the space. And then she came up with an ultimate number of like about $1 billion. So if you look at the heat map here, it looks like that's what she defined it. So it's very interesting because one person says it's IT training, and another one is like cybersecurity. And this could also vary because a lot of companies in terms of their industry is not always apparent. Like, for example, this company, right? So like, how do you define this, right? So let me hear your thoughts here, guys. What industry is this? What do you guys think?
Probably. Yeah.
Do you think it's just ed tech though? It's a secure single sign-on.
Is it a mobile app?
So let's take another look. Okay, so it's a school passport, right? And let's see, let's try to get more info on what they do. So how long is this video?
Schools today rely.
Okay, let's not go through this. Okay, so school-centric trusted digital engagement hub. right? And then you enable ubiquitous access to all apps within any LMS. So basically, what it's doing is that when you're logging into, for example, like a Canvas, so that no one steals your data, it has a separate portal that integrates into that interface to protect against, potential, I don't know, grade manipulation or extrapolation of data, all that kind of stuff, right? So they sell to ed tech businesses as well as schools. So would you categorize this as something like ed tech or cybersecurity, right? It becomes both, a little bit of both, because of the product that is sold. You can't completely say it's 100% ed tech. You can't completely say it's completely cyber tech because it is ed tech, right? But within the ed tech, it is cybersecurity. So it's not that clear cut and dry. Another example is, let me just pull up another example here. I can't remember the company name, but you guys get my point, right? Okay, so this is another interesting example. So focused learning, right? So what do you guys think this company does? And what industry would this be? So nuclear power plant, public utility organizations. So this is, I'll just cut to the chase. This is professional training. It's a web-based solution, but they only train nuclear power plant employees because they have very, very specific guidelines. So you can't just say this is ed tech, or you can't just say this is nuclear power plants industry, right? You have to carve out a niche within that. Or you could say that the other argument is that depending on how the product is, you could make a case that this is the whole entire ed tech, because you could just say we can skim, right? Skim through the software and recreate it for all these other industries, right? It could go either direction. So there's a lot of science, but there's also an element of art where you need to interpret your own way to come up with your TAM sum and sum. It's not that clear cut and dry. This is why the assumptions are so important, because that's when you talk to investors or your other co-founders or the bankers when you have a business plan to debate, right, on whose assumption that you go off of to come up with the final financial projections or the term sheet, if you're trying to negotiate to close a deal. So those are, a couple more examples here. And this is another student that took average price per course, number of listed companies in the world, and then took average number of employees. So very, very simple. He or she doesn't seem like they trimmed this down geographically based on, what we see here. But he or she went with IT, right? Security, sales, leadership development, and other e-learning courses. And this is just a very similar example. So now it's like, 16 billion for Sam, which is a lot higher than some of the other estimates, and 18 billion for the other one. So this person broke it down based off of the revenue that could potentially be collected by the size of each company. So they took a completely different route coming up with TAM sum and sum. Numbers are all over the place, but nonetheless, the assumptions are what makes or breaks these decisions. Okay, so does everyone have a good idea of TAM sum and sum, or able to kind of have an idea on how they want to actually create TAM sum and sum? Okay, any questions? No? Okay, great. So let's take a, what is it, 10:01, 10-minute break, and then we're gonna do some financial modeling, guys. Hang in there, we're almost done. We're almost done. Okay, you guys are doing great. Okay, we'll be back at 10:10. Okay, mi amigos, how are you guys? Hey, Elena, there she is.
Hey, Kevin.
Oh, shoot, I totally forgot. So guys, if you go into Canvas and go under module 2, please download the latest Excel spreadsheet that says deal valuation exercise so you can follow along with Elena.
Yeah. Hi, everyone. I'm really excited to be here.
Wait, hold on. I'm supposed to
introduce me.
Wait, I'm supposed to introduce you. Okay.
Yes.
So Elena is a University of Chicago alum. She was a CFO that went public in the oil and gas industry 4 or 5 years ago. She's had a CFO title pretty much like the last 10 years through various businesses. She's done numerous acquisitions in the $5 million to $40 million range. And currently she's the CFO of Founder Legacy Partners, where we look at deals pretty much in the $20 to $50 million price range. So today, she was very generous enough to offer up her time so she could kind of share with you guys, how financial modeling is done and what are some of the things that we look for when we're trying to assess the valuation of a company. So yeah, without further ado, Elena, why don't you just take it from here?
Yeah, thank you, Kevin. I'm really excited to be here, guys. And as Kevin mentioned, we're going to talk about valuations. And if you have a chance, please download the file because it may be useful for you to go along with me and work on this exercise together. Kevin, would you mind actually giving me the, okay, I can share the screen now, right?
Yeah. Okay, good.
Yeah. Yeah, so you should have this file and we are going to work on valuation today. Yeah. So there are many ways of valuing the company. And I guess the easiest one is to value a public company. If you go online, you can just look up the share price of the company, and simply if you multiply the number of shares by the stock price today, you can get an idea how much the company is worth as of today, right? And so it's very simple for public companies. However, for private companies, the situation is totally different, and that's what we work with at FLP. Kevin is looking to buy private companies, and I feel like this is a very interesting exercise because it involves a lot of technical knowledge, but also a lot of intuition. For private companies, there are several ways to determine the value of the company, but I think the most popular one is the multiples. If you have time, we will talk a little bit more about other methods, but multiples is something which we'll pay attention right now to. Yeah, so if you go to the file called comps, usually what we do, we look at comparable companies. Comparable companies can be public or private. Again, it's very easy to find information for public companies. They are out there. For private companies, it's much more difficult. There are databases like PitchBook and some other ones which will be providing this information. As well, if you work in the fund industry or investment banking, you will be familiar with transactions themselves. So it will be easier for you to actually know how much companies are sold for, what price, what terms and conditions of the deal. And we can try to do this exercise using information we can find on the internet. That will be one of the tasks today. Again, for comparable companies, it's not an easy task. So even though we have public company information, if I look for a private deal, usually they tend to be smaller than the public company sizes anyway. For example, you can, like Google or Microsoft or Cisco, they have huge valuations. And if you look for a small SaaS company with, I don't know, $10 million in revenue, valuation will be totally different. So in a public space, you would want to try a company which has similar size or at least similar market to the company that you're trying. Okay, sorry, I'm going to repeat myself again. So your target company should be in the same market as the public comparable, and it should have similar size if possible and similar capital structure. Again, it's super hard to find. There's no guarantee that you will find the good comparable company, and that's okay. You can just do your best and do what you can. It will be fine. Usually you want to find 5 to 10 really good comparable companies. If you can find 50, there is no there is no limit of how many companies you can use for this exercise, but the 50 companies will not provide you better information. So if you do 5, 10, that's more than enough. That's absolutely fine. And for example, for this company, I will also provide it here, use some information on the preceding transactions from our search. These are the real deals, and you will be able to use this information for your exercise. You don't have to look for this one, but if you want to, it's also pretty straightforward. You just have to look for announcements on the internet, and often you can find information. You might not find all information, but you might find how much company paid for another company, or what was the revenue, or what was the projection. So you can find some information, but it's much harder. This is why we gave you this little help to see how it works in real life. Yeah, so today we're going to work with the company called Zoom Video Communications. You are familiar with that company. And this is a public company, but I think it's a good example because you're going to work with the software company as well, right? Kevin, that's my understanding. Okay.
Sorry, my monitor went out, so I'm fixing that.
Yeah.
Yeah, that is correct.
Yeah, so I will have to warn you guys. So I used here very large corporations. As you see, information is in $1 billion, and the company you will be given is very small. So you should find better comparables, but I think it's good to learn on the very clear deal, and because information is available publicly and openly. So what I've done, I downloaded 10K for Zoom for 2 years. And sorry, let me check. And you can do the same in your own time, but I'll be walking you, you will be working together with me through the exercise. So I can show you where to find information and how to work with it. Today, we're going to have a very, very, I guess, basic exercise. So don't worry about stuff that you don't know. For example, here, I put comments of what net debt is. To be honest, you don't have to complete this column, but for those who are interested, you might look into it and work with the numbers, trying to understand how it's gonna be if we use, for example, net debt, how it will affect the valuation or other metrics. So let's go and work with Zoom. So for those who can download the file, let's try to work together. We always start with assumptions when we try to value the company, and assumptions is probably the most important part of the valuation because, let me show you. So
maybe we just talked about that yesterday.
Yeah, so usually if you look into this file, right, you see that all projections are literally based on the formulas, and it just simply means that what your assumptions are driving the whole valuation, and this is why it's very, very important. And once you're going to have a complete file, I'll show you how valuation changes significantly, and you will see that assumptions is something that that is very, I don't know, it's like, it's the core evaluation. And to get a feeling or get a good assumption is, yeah, it's the most important thing you can do in valuing the company. But let's start with the basics. Oh yeah, by the way, if you have questions, please do ask, and we can try to work with them together now. For those who don't want to ask questions straight away, we can open Q&A section afterwards, after the exercise.
Lena, why don't we just pause here and let any of the students ask any questions thus far?
Yeah, guys, go ahead.
Yeah, no questions. I told you they're really smart.
Yes, they are. Yeah, I'm sure it will be clear once we start working with numbers, so that will be there. Yeah, so we work with assumptions first, and that's very important. And I actually inserted some assumptions here, so it's easier for you guys to follow, I guess, or so we don't have to, I guess, spend additional time trying to figure out. But we're going to walk through assumptions as well, and we'll discuss why we use these assumptions or not something else. Yeah, then we're going to start working with the income statement. Income statement is the most important statement for evaluation of the company using multiples, simply because the multiples valuation is calculated as EBITDA multiplied by a multiple, and that gives you the value of the company. And if we have information on the balance sheet, we also will have enter this information, and we will see how our company structure will change if we buy the company or if we add additional capital or debt. So it will be very interesting in the size. Okay, I guess we can start with comps maybe. So we get out of the way. For Zoom, since it's a meeting solutions company, I picked Google, Microsoft, and Cisco. All of these companies have their own platforms, and they have, I guess, similar market value for this kind of business as well. The only issue with Google, for example, everyone knows that they like, I don't know, $1 trillion company, right? And they have several business models. And usually when you do proper valuation or proper search for comparable, you would actually dissect Google's financials to understand how much a particular business worth in the company. So ideally, we would look for the meeting solutions business within the Google itself. But in the, how to say, we don't have that much time because it's a separate class for 8 hours probably. We can just assume for this exercise that main Google's business is meeting solutions, right? One way to do this, you can either just Google stock market of the company you're looking for, and you can directly actually Google the industry capitalization numbers. For example, on Finance Yahoo, it's a very popular, I guess, search engine. It's free, so anyone can just enter the name of the company here, and we can get information on this company. So for example, Yahoo tells us that Google's market cap is $1.7 trillion as of today. And we're going to use this information to put it here. I want to draw your attention to the fact that here, it's important to show what, I guess, what numbers you are using. So in this case, I'm saying that these numbers are in $1 billion. So $1.7 trillion will look like that in this case. Then Yahoo is also very convenient in a way that it gives us some brief summary about the company. And for multiples, to be honest, if you find a good comparable, that's all you need to complete this table. So then here we can complete then net debt. You don't have to do it, but I just wanted to show you how to do that, right? go to balance sheet. And here they will be showing you the total net number. So you're gonna use the last number available. So some companies, okay, I have to rephrase it. So companies have different reporting period. Google, for example, has December 31st. Many software companies have July 31st as their year end. For our purpose, it doesn't really matter because for this exercise, we assume that there is no seasonality in business and that any last financial date will be fine for us. So here we see the numbers. We see that total debt is $26 billion, and that's what we're gonna insert here. When you do this exercise, because in this case, we see that we need to include net debt, not just gross debt. And we need to calculate it using this formula. So we add all short-term debts and long-term debts and deduct cash and equivalents. So this one is important number in valuations usually because when you value the company, you want to know two numbers. You want to know total enterprise value, which debt and equity. And you want to know how much value the equity has. And usually when you buy a company, especially a small one, the company will have no cash. So for you, it's important to know what is net debt. Because for example, if their debt is $100 million and they have, I don't know, $80 million in cash, in this case, you will have to pay to the debt holders only $20 million, right? But if the company has $100 million in debt, but they have zero cash, effectively, then you're going to end up paying to debt holders $100 million. You see the difference it makes depending on how much cash the company has. It's very important to know that. For companies like Google, by the way, we're going to have a negative net debt. What it means? It simply means that the company has enough cash to pay off its debt and actually working capital and everything it wants to. So the second part of this net debt calculation will be cash and cash equivalents, which is 137 million. Oh, we can just use with that 136 and 6. So you see, the Google will have a negative debt, which is great. Yeah, these companies, they're usually very well capitalized, so they don't really need debt. And you see the numbers are very, how to say, the debt is very small comparable to the company's size. It's like $26 billion compared to 1.6 trillion, which is a, how to say, yeah, so they're perfectly fine. Then the next step will be to look at the revenues and find the multiples for revenues. So we go back to the income statement. And here it is. We again provided with all the numbers we need to. I wouldn't use this number because TTM simply means trailing 12 months. So this possibly will be part of 2021 plus part of 2020. And it's good for estimating the market value as of today, but to be honest, for valuation purposes, I would just use the last reporting date simply because you have all information you need to understand where the company is going. This is good to, for example, to verify your forecasts, to see like, hey, is my assumption correct about this company based on its historical information and based on information available to date, right? So here, unfortunately, they don't break down the revenue by the business model, which would be great. But often you will find these companies that even though they have 5 different business models, and theoretically you should break down the company's business into 5 models when you value it, you have to value each business separately because they have different risks and they have different valuations. But like 90% of the companies, they will try to allocate the revenue in such a way that for you it will be hard to understand the real value of the business. Because in this case, how to say, in case something goes wrong with one business, nobody knows about it because it's compensated somehow because all these businesses are blocked up together in a way. I think Microsoft and Amazon are both famous for that. Everyone wants to understand how much AWS business worth or how much a Microsoft cloud is worth, but nobody knows what is the real value of those businesses because just the way they allocate the businesses together, it's very tricky. So unless you work directly for these companies within those departments, you will never know how much the company is really worth or how much that business is really worth. But yeah, so for our exercise, we take the total revenue number. So we take this number. LTM means last 12 months. And for us, last 12 months simply means the last financial years for this exercise purposes. So we take this number, 183, and 2019 number here as well, 162. Usually, next number is EBITDA. Oh, by the way, yeah, I think I forgot to mention that usually when you use multiples, multiples are applied to like most often they apply to revenue or EBITDA. This is very common way to value the company, and you will see on our exercise what's happening there. So next you go to look for EBITDA numbers, and again, Yahoo is great because usually EBITDA is not published and it's something you have to calculate by yourself. So if you use the financials, the 10K financials, like this, you would actually have to go to the income statement and you will have to deduct depreciation and taxes and all the other items, and you will have to basically come up with EBITDA. But most of resources already calculated for you. So they have here what they call normalized EBITDA. Normalized EBITDA is a better, I guess, metric to use simply because companies do a lot of activities. They buy something, they sell something, they might, I don't know, like have some restructuring going on in a year, like probably 2020, many companies had restructuring. So all of these costs, while they're affecting EBITDA, they're not necessarily going to occur next year. And this is why you simply adjust your EBITDA by these costs or gains or losses, depending on what happened in the year. And you come up with normalized EBITDA. So normalized EBITDA is assumed that, okay, so usually that's how the company would have performed if it had standard operations. So for 2020, it will be $55.9 million. And here, usually what you take excluding share-based payments to the employees. The reason being is that oftentimes this is a very high charge, especially in companies which pay a lot of stocks to the employees, like Google, Amazon, Microsoft, basically all SaaS companies. Oftentimes it can be a very high charge, and you would want to know the numbers without this like expense. I assume you can assume simply that for this exercise purposes, normalized EBITDA is adjusted for share-based payments, so you don't have to worry and calculate it. Again, it's a difficult exercise, not something we need to talk about it today. So here we are. So that's all you have to do really with the comparable company, and that gives you a good expectations of what the company value is. So in here you can see that if you take multiple for revenue, then you need to use 8.5x of the revenue to value your private company. And you can use either current year, or I guess 2020 years for our purposes, or you can use 2019 year. And this will affect your valuation significantly because you see, So we have different multiple every year. There is no right or wrong multiple, to be honest. You usually just make a choice based on your, I guess, past experience, based on your intuition, based on your valuation in general, and also based on the how many bids are out there. For example, when we worked on one deal, we knew that apart from us, there were 5 other bidders and they were offering higher price. And that's how, if your valuation is, for example, 8.5x of 2020 EBITDA, but you know everyone else pays or offers for this company 10x EBITDA, then it's up to you to say like, hey, I actually agree that my valuation should be a bit higher, and I want to offer also 10x EBITDA or 9.6 EBITDA, right? But I also might say, no, everyone else is wrong, and or maybe they have different strategy. This is why they offer higher price. It's a very, it's not a strict number. So even if you get 8.5 or 9.6, it doesn't matter. Doesn't mean that you have to offer this number. It's all about negotiations. The same for EBITDA. So you can see that for Google, you can offer 27.9x of EBITDA or 31.1x of EBITDA for 2019. With Google, it's a bit difficult to really apply EBITDA. Usually, the public company like that, they use discounted cash flow valuation. I think it's a better way to understand their business than simply multiples. It's simply because of how big this business is. So, and it has so many businesses within that applying the multiple is really not gonna give you like, I guess, the correct valuation, but it gives you some like some threshold. So we're gonna do the same with Microsoft. Do you guys have any questions so far? Please feel free to just jump in anytime.
Hey, Elena, do you wanna talk a little bit why a strategic buyer would pay more sometimes?
Oh yeah. So the interesting fact. So the companies. Sometimes the companies. Well, okay. So you do acquisition for several purposes, right? Sometimes you see the opportunity, like Kevin, and he looks at businesses which are, in his opinion, are legacy businesses and they need some improvements on the operational level. And that's how he believes that he can create value and make valuation of the company higher. For example, if he buys a company which is worth $30 million, but then he's got people which can improve software, and he knows he's also better at sales, so he can grow the company faster. That will give him additional value, and he can sell this company, for example, at 50 million in 3 years, right? But there are also other companies, like Google, for example, is a great example, right? Even though their main business was like search engine and advertisement, which advertisement was actually the one which was making money, they were looking into YouTube as a strategic acquisition simply because YouTube has similar different business model. YouTube allows you to search for videos and find information, and in reality, that's what Google is selling. They're collecting and selling information, right, to advertisers. And this is why they made acquisition of YouTube, and this is why they paid so much money for YouTube. They paid like, I think, a couple of $1 billion for YouTube. And they, since YouTube was, I don't remember if it was a public company at the time, but they definitely paid a high margin, high premium for YouTube because they knew that by buying YouTube, Google's valuation will go up simply because they will have more synergies. They will be able to have access to more information, and hence they can charge more to advertisers, right? So they can scale their advertising business at a much faster rate and make it more efficient, probably even, by acquiring YouTube. And the same with Facebook, right? So Facebook was having all those pictures, and then Instagram came up, And they were becoming competitor of Facebook because more people were switching to Instagram. So they had no other choice but to acquire that business. Yeah, that's another part, is that you can also acquire a competitor to make sure you remove this company from the market. They also paid, so Facebook, I think, is the one who started like $1 billion acquisitions. They were the first company who offered over $1 billion for a tech startup. And there were actually a lot of interesting talks about this. Nobody wanted Facebook to pay this much money, even though everyone knew that Instagram was threatening Facebook business. But just everyone knew that once somebody is going to pay $1 billion for a tech company, that's it. The prices, the low prices for tech companies are gone. And that's exactly what happened. Now you see that Google paid even more money for YouTube, and like any startup which has any scaling potential, the tech startup, you see how much money people pay these days. And Facebook, I think, is the one who started this trend, unfortunately, or fortunately for them, but unfortunately for everyone else who wants to buy a tech startup. And yeah, and another interesting fact, actually, that yes, when a big company buys something for strategic purposes, they usually overpay, and especially if they buy a public company, they often pay premium 30%, up to 30%, I think. It's a very common thing. This is how deals done at this level, I guess. And unfortunately, despite these high prices, I think around 75% of the deals are failing. And what is the good example? I forgot. I think Yahoo is a great example, right? Definitely look at the company, right? It used to be so big, but then I forgot which company acquired it, but now their valuation dropped so much, it's crazy. Yeah, I don't remember right now at the moment, unfortunately, the names, but if you look up on the internet, you will see definitely that many big companies were buying something and it failed. I think IBM was buying something and it didn't work out. And often you will read Wall Street Journal and you will see that this acquisition didn't generate any synergies. Yeah.
I think the company, wasn't it Mark Cuban's company that he sold to Yahoo and then it tanked after he sold it?
Possibly. There's so many.
That he sold to Yahoo or something like that. I can't remember.
Well, the best I can't remember right now, but there's so many. If you just search like failed acquisitions, you will find, because you will see every year that this company paid billions of dollars for that company, and 3 years later they they impaired like 70% of the value of the company. It's so common. There's so many academic papers on that trying to understand why the M&A fail, but it's for M&A to fail is much more common than for it to be successful. And despite that, people still buy a company every day, right?
I posted a quick blurb. I mean, basically, Mark Cuban robbed Yahoo of billions of dollars in that sense. That's how he became famous.
Yeah, so there are plenty of businesses who fail. Yeah, and so if no more questions, then we can carry on with Microsoft. Okay, I think actually. Okay, guys, so there will be a file which is completed. For the time's sake, I'm gonna try to talk to you about other stuff as well, because it's very important. So, as I said before, I gave you the real transactions, which will be useful for your exercise. So for you, it's good to compare the public company multiples with the multiples for private transactions. So they are the same. You take enterprise valuation to revenue, or enterprise valuation to EBITDA. So the same principle, absolutely. But you will see that multiples are totally different. You see, if for Google we had 8.5x of revenue for this deal, which is totally minuscule for Google, probably one day of, I don't know, like one department or 1 hour of one department expenses. You see this is valued only at 3.5x. And the same here and the same in here. EBITDA the same, you see how much difference it is. And this is why if you take such large companies like Google, Microsoft, or Cisco to value a small company, you will not really find a good multiple because they have totally different business risks and totally different growth patterns, right? So for your exercise, I would prefer to use these multiples, but you can play around just to see how valuation of the company will change based on the multiple. And here, for private companies, so many people try to use the public companies multiples, but the standard rule is for private companies valuation is that since risks are different, for example, Google has no debt and it has billions of dollars in its cash account. So Google definitely will not go down tomorrow in the next 12 months, unless something like the world crashes, I don't know, or the war starts or something like that. But for private company, any private company, especially a small one, can go down of business like next day, literally, right? So they're much riskier. And to compensate for this risk, you apply discounts. So here we're going to use the multiples from public companies, but to calculate our company valuation, we actually will deduct 30% of that valuation and apply it to our company. It's a standard rule, and when VCs value companies, they actually apply even 50% discount. Even they go even like bigger to make sure that they accounted for all the risks which you can't really think of. So let's go back to our assumptions. Okay, so now after we worked with comparables, we will try to create valuation and forecast for our company Zoom Video Communications. Again, this is purely for exercise. Your company will look different, and especially if you work with smaller companies, many of them have very, they don't have audited financials. Many of them have financials done using cash basis, which is totally not helpful for our purposes. In your case, you're going to get financials made on accrual basis, so it's good. You're going to have income statement and balance sheet, so it's great. But for majority of small companies, there is nothing really to work with. You really have to actually invent numbers, and that's why multiples and precedent deals is very great for you, because by analyzing public companies' information, you can actually come up with your own metrics, which will allow you to estimate the small company's performance. We'll try to do this now. So here, Zoom is a public company, so we have access to all of this information. Again, you can use 10K. I use 10K simply because I like it more. But again, you can use Yahoo Financials. Yahoo might give you slightly different numbers, but that's okay. If you, for example, if you would do an exercise somewhere else, you would just simply put somewhere your source. You could say, my source was 10K, and then people know how to track your numbers, right, to verify them. Or you can say, hey, my source was yahoofinance.com, and then people also will be able to verify you. So as long as you leave the source, you'll be fine. And yeah, so over here, let's go here. Remember how, please notice that here numbers are in thousands, and here numbers are in millions. In our case, I'm simply using millions because it just looks better. We have a lot of columns, so we can use thousands, but it's not gonna look good, and it will be hard to analyze. So that's why I'm using a bit different, what do you call, valuation values, but it's fine. So yeah, so let's work with last historical year. Another thing with Zoom, you will see that its financial year ends actually on January 31st, 2021. How would I work with this, right? So I still want to say that the last financial year was 2020. Why I think it is correct thing to do? Simply because there is only 1 month in January when Zoom shows something to us, right? So majority of the numbers are for 2020. And on DCF, you would actually use proper dates, and you would, like, you use, to value the company, you would use the fraction of the date, but for our purpose, we just assume that if, for example, majority of the months of the reporting period fall in 2020, then we assume that last historical year will be 2020. For your exercise, the year will be ending December 31st, so very straightforward. There shouldn't be any issues. For our purposes, we use this. And then we go here onto the income statement. You always start completing with the income statement first to understand the situation. So we can start with the past years. You can start with it. So you can complete in any order. It doesn't really matter, but I think it's interesting for you to see on this example, because the performance of the company changes so much in this 4 years. Oh, okay. So for this part, the historical analysis, that's what I call it. You can use 3 years. It's totally fine. If you have 4 or 5 years, it's great. The only thing you have to be careful about is that it's great to see the history of the company. It's great to see the trends of the company, but just because trends in the past, there were trends in the past, it doesn't mean that they will continue in the same way going forward. So that's something to remember. If you're going to work with valuations, you will develop some sort of intuition, which will allow you to see, I guess, the patterns and tell, hey, will this pattern continue going forward? Or actually, this is something which was one-off, but it's a bit, how to say, it's a different lecture. So let's try to complete this file. Again, here the same story, year ended January 31st. So assume this is 2017. Let's complete the revenue numbers. We have here in thousands, so just shorten it to this number. So like that. To shorten the number, you use the simple rounding rule. If it's 5, then you round to 152. If it's 4 or 3, you just leave it as 151. You will often have, after you complete and round like that, you will often have balanced, not balancing by 1 or 2. It's totally fine. Just add 1 or 2 somewhere here, and that's okay. It's a standard situation. Everyone knows about it. So we completed cost of revenue, which is cost of sales or COGS. It's called differently, but it's the same meaning. So large companies break down the operating expenses into 3 parts, and I think it's very useful because it helps you understand trends better. It helps you understand how much money they spend on research and development of software. It helps you understand how much money they spend on sales and marketing, which helps you understand or maybe make your own assumptions about how effective the marketing campaign was, right? And what's happening with their G&A, like how much money they spend on, I don't know, administrative folks. That's a really good way to break down the same costs. But unfortunately for smaller businesses, the majority of the cases, they will give information which is just called as G&A and other expenses. They might be called a bit different, but definitely there will be a major line as G&A. not many will provide information on sales and marketing or research and development. Of course, if you do proper due diligence, you will be able to get these numbers, but at this stage when you just have to give, when you have to get an understanding of how much the company is worth, you likely will not have this information. So this is why, for purposes of our exercise, I'm simply adding, I'm simply using the G&A cost and adding everything together, everything else together as other expense. Does anyone have any questions of why am I doing that? Okay. Oops. Okay, so we have this. You see, for example, in accounting statements, you will see this number, right? Income loss from operations. But for our purposes, we have template which is built for valuation. So we will be using different metrics. So this is how we see the EBITDA already. Then we use one here, and that should give us costs. Let's see, distribute 1, 3, 4. Okay. Yeah. So that gives us net income of like that. As I said, there will be, because of the rounding, you will have the small differences, which is totally fine, right? So 3.5, and we use here taxes are 0, so we're going to end up with 3.8. Don't worry about this part, this accounting stuff. So we have depreciation left out, so we need to find it in financials. You can find depreciation in the notes. It will give you the numbers. It will be usually note 9 or 10, something like that. Well, actually, it's note 5 in this case. So here they will give you numbers for depreciation for several years, right? 16.4, 7, 2.8, etc., etc. So we use, to be honestly, it doesn't matter if it's depreciation, amortization, it plays the same purpose. It just simply means that you have to come to the EBITDA metric because this is the one which we care about. So they don't split it here. It's fine, we just say like it's depreciation, just use it. And I'm going to complete for other years as well because it's hard to find it. Okay, so here, however, we need to remember that in this particular situation, the depreciation and amortization wasn't shown on the income statement as a separate item, which means simply, you see, so there will be depreciation here and amortization and here. And we got this information from the notes, but we don't know where it belongs to. So let's say it was part of the, for example, SG&A, right? It definitely won't be in sales and marketing because this is simply cost to run marketing campaigns. So we can put it into SG&A, and we're simply gonna make this little formula, which will adjust our SG&A by this depreciation. We're gonna repeat it here as well for now, and we're just gonna add SG&A numbers for other periods. So that's the rule. We deduct depreciation from here to come up to the EBITDA, and then we put it here. Next year, same same situation. We just plug numbers in. We use general administrative numbers as standalone numbers, and we simply add the rest of the numbers together. This is not correct, but for these purposes, it's good because that's all we need to see anyway. 6 plus 3, 5. So you see how quickly we have 3 years completed. Provision for taxes. For those who are, I don't know, wondering how much taxes companies like Zoom pay, this is how much taxes they can actually, they accrue for 75 will be 1, and here we can say it's 1. There is a special breakdown for taxes as well. It's just for your general knowledge. It has nothing to do with the valuation. Yeah, income tax is number 10 actually. Yeah, you see, so how little taxes they actually pay. Look at this, right? And look at this effective tax rate. So the company effectively paid nothing in 2017. They had paid like 9%, and in 2020, or I guess 2019, 4% only. And just see how minuscule this number is compared to the revenue, right? It's really crazy that by making so much money, they pay like almost no taxes. But yeah. Okay, while we have the numbers open here, we can complete the balance sheet. So balance sheet will be a bit more complicated. You will have simpler company, and this is a large company, so they have slightly different outlay, and that's fine. It is what it is. But I'll try to explain to you how to complete the public company information. It doesn't really. Okay, try to do this way. So the year 2018, which is for us this year, and I don't know if you noticed, we have used 4 years here, and here we're going to use 3 years. The reason being the growth of our revenue and EBITDA. Because if we have only 3 years here, then for us, we can calculate change only for 2 years, but by having access to 4 years, we can actually estimate the growth rate for 3 years, which is a better way to understand if there is any trend at all of what is it. Okay, the balance sheet. So this balance sheet is, I guess, is a standard balance sheet for companies which do, for SaaS companies. And the main difference from the, I guess, other companies is these 2 items, deferred revenue and deferred contract acquisition. Simply because many SaaS companies, Zoom charges customers, so they can charge you several different plans, and one of them you can pay 1 year in advance, which means that you will pay cash today, but they will provide you services in the next 12 months, right? And that part goes over here, deferred revenue. So on their balance sheet, it becomes a liability. And that's the main difference, I guess, between the standard services and the SaaS companies. Because not many companies has ability to charge 1 year in advance. Yeah. So let's take this balance sheet and work with it. Cash is very straightforward. It's going to be 64 million here. Marketable securities. Yeah, many large companies, as you see, they have plenty of cash on their balance sheet. So what they do, so it doesn't sit around and just being wasted, because shareholders will be very unhappy with this situation. They try to buy some liquid bonds or liquid liquid assets, which make some money to the company, and that's where the interest income come from. You see, even though it's a tiny interest, it's still better than just be sitting in your own bank making zero money. So we're gonna use put this one into the category other current assets. Again, this balance sheet is made for small companies, so it definitely not that great to use for large corporations, but we're just gonna use whatever we can, right, for this valuation task. Then accounts receivable 64. For you, it's important to actually make sure that you have correct current assets and current liabilities, because later we're going to calculate net working capital, and this is a very important metric for the company. And I'm going to talk about it a bit later once we have it completed. So yes, so this is other. Then deferred contract acquisition cost 44. This line you probably will not meet in your in smaller companies, but I just added it because yeah, I think it's an important line to talk about. Prepaid expenses are going to be here. Property equipment here. Operating lease. Yeah, you see how I add everything together into other lines, simply because for purposes of our exercise, it's not really relevant. But normally you would try to create an item like this, cash, accounts receivable, or more, maybe like prepaid expenses for any items which is, I say, 10 to 20% of the total assets number, because you would want to understand what this large number is. Okay. Oh, I think I'm using different numbers from different years. Okay, let me look at it again. So 64, 112, 113, and then we're going to have, okay, so like that, other current assets, it's going to be 10, and then we're going to have the full, okay, 29. Sorry guys, I just used different here because it's very small screen. And we missed another one. Okay. 26. So I'm missing one number. Oh, okay. So there are two. Okay. Okay. Okay, so we have always check that it match the financial statements, the total assets and total liabilities and equity. Usually more straightforward. So here, there is deferred revenue non-current, but I simply used it as other non-current because you would really care about this number, and this number is there for more than 12 months, so you can think about it later. Here they have convertible stock, but simply we have no space for that, so I'm simply going to call it a senior debt. It's not correct, but for purposes of this exercise, we're just saying that the company has debt. That's good enough. And again, it's a large company. We're gonna have private company. Private company will have founders share. So, and they're gonna likely to have shareholder distribution, which this company doesn't have, but that's okay. We simply add all of this stuff together, and that will give us somewhere like $18 million. And you're gonna have 25, oh, sorry, 25, 4.5, and somewhere there's a mistake again, 160. Okay, that will be, let me see, 202 is correct. 160, oh, minus 225. Okay, that's correct. Similar one with the 2019. Does anyone have any questions about how to work with the balance sheet numbers? I know I did some confusion. Yeah. Yeah, the only way is really just to keep checking the numbers. There is no other way to understand what is happening. Okay, so that should be good enough for this one. And again here, and have here, 23, 10. Other one. Well, operating lease, it's usually some sort of debt. I can put it here, but you will not have it, so don't worry about it. Just for general. You will not have the long-term deferred revenue either, so don't worry about it again. Here I have 457. I think it's because of this, and we're simply gonna reduce this one by 1. And you guys gonna have access to, oh, actually, you're gonna have access to the complete file, so don't worry if you won't have time to complete some things, because I also want to show you how evaluation works. So we might just go and work with that file. Okay, so let's actually, okay. Let's go back to the income statement because I want you to show the last year for this company. So you can see, we can talk about patterns a little bit and see how it affects our business. And actually, what I find with Zoom, it is crazy how the company's business changed in literally like 3 years. It's amazing. Yeah, let's just assume here it's 17. I don't know if it's correct, but it won't be much different anyway. They didn't do any crazy acquisitions. Provision for tax, more tax. And then I'm gonna have here. Oh, actually, it's perfect to see. Very close to what we just estimated. And the balance sheet here. Cash. Did you notice how much more, how cash grew? It's insane. Literally like 3 years from almost nothing to $2 billion.
Elena, should they pay dividends?
What did you say, sorry? Should they pay dividend?
Yeah, what should they do with the excess cash? Should they pay dividends?
That's a good question. It depends on what the company, I guess, investment policy is. So I know Amazon never pays dividends. That's the actual strategic. That's the strategic goal. And if the company is growing, I wouldn't pay dividends because usually mature and stable companies pay dividends, and that's why everyone wants Amazon to pay dividends. But they still insist that they're still startup, it's still day one for them, right?
Yep.
Yeah, it depends. Sometimes shareholders will actually demand dividends, or sometimes if they, usually you hire executives for 5 years or so, and if they want shareholders to make happy, they might actually pay dividends to them. But usually you would expect to reinvest this money into the business. You would expect to buy something. And actually for smaller companies, having so much cash on the balance sheet, they become target for acquisitions. And that's why companies are trying to get rid of cash as fast as possible. I guess it's harder to buy Zoom because what is their market value? Not many businesses can buy Zoom that easily, but if you're a smaller guy and you have cash, you are in trouble because everyone wants to get their hands on the cash. Yeah, so they're $110 billion. But if you were a $50 million guy and you had like $20 million in cash, you would be very wanted. Okay, sorry guys. Again, 25 here. Yeah, thanks for asking questions, Kevin. Yeah, guys, if you have any other questions like Kevin is asking, just doesn't necessarily have to be about this valuation, just in general about what's happening, or maybe something you would like to know about valuations. I'm happy to answer.
Are there no like apps that could like take the numbers and paste it like faster by any chance yet?
You usually would work with, there is no app. That's exactly what investment banking analysts are doing. They just type in numbers.
Yeah, that's crazy.
It's a very glamorous job, as you can see, guys.
Why do investment bankers get paid so much? That's what I want to know.
Because because they don't pay for enter the numbers. Getting paid for making the deal happen, because they simply work with the company who wants to buy or sell something, right? And investment bankers get percentage of that deal, and that simply means that like they usually, if it's a $1 billion deal, they probably take 1%, so it's $100 million for a team of 5 people, right? So that's how they get paid so much.
And that's my next question is, why do iBankers as an analyst have to work 100 hours a week? Why can't they just hire 2 analysts and do 50 hours each?
That's a good question. I think it just how it was from before, from Goldman Sachs, so Goldman Sachs actually, they started, or what was before Goldman Sachs, was it? I forgot, Lehman Brothers and stuff. It's just the whole working culture. That's how it started. So there is no really reason for that, because as you said, you can hire people, you just can pay them a bit less, but you can have as many people as you want to. It's a corporate culture, that's it. And speaking of that, actually, so we were studying some cases about very successful women who spend their like nights and days and every waking hour with Goldman Sachs, for example, right? But one woman, when she took, she was like a top performance person in the company. She was promoted so quickly. She brought all the deals, everything. But then she decided to have a family, and she literally was looked at as if she, like did nothing as if she was nobody. So her recognition disappeared in 1 second. I don't understand why is that. And she was shocked to hear that from her boss. Yeah, because when she declared she was having a baby, he was like, oh, like, we don't need you anymore kind of thing. After all hard work she put. Guys, for the time's sake, I couldn't find $6,000. I just put them somewhere because I want to talk to you about something important. Or 7. So let's look at this. So we can assume that this is our valuation, right? The only thing which is missing after completing all these files is our multiple, which will be entry multiple. And we can use it based on our comps. So yeah, this valuation is totally fake because you cannot value Zoom based on multiples. It's simply, the company is too large to apply multiples. You would usually run DCF valuation at least. In reality, you would run several valuations, but yeah, multiple would be one to give you, I guess, a range, but you will never use it as the correct one, that's for sure. In this particular case, the company is too big for this purpose. For small companies, multiple is the best because multiple gives you a range. It doesn't give you like a number like DCF, right? And it gives you some sort of, I guess, space or room for negotiations in the situation. So based on our comps, I tend to use EBITDA comps. For tech companies, usually everyone wants to have revenue multiples, and I will not lie. Usually, if you have a good business which is very scalable, you can expect to get a 10x of revenue for your company. And many companies are doing that. The reason why they can request revenue multiple, not EBITDA multiple, because if you have a good product and all you have to do, you just have to, I don't know, add additional equity to buy more customers, and that's it, and you're like going off the top. And this is why Zoom was a great example. Just look at this performance, right? 2017, 1.2, 331, 623, 26, like whatever. Look at this revenue growth. It's they're literally making like almost 100% a year. That's the growth, right? That's insane. So if you have a startup which grows 100% a year and your software is working and you have proven concept and you have, I don't know, $10 million in revenue, which is recurring revenue, that's a different term. Then you can expect to ask 10x for your company. And the reason why it's revenue, because effectively you don't have to incur any additional costs. So if somebody buys your company, they effectively will be buying your accounts, your customers, which are bringing you steady revenue. And this is why you ask them for the price based on the revenue. However, the business you're going to work with, even though they also say they're a SaaS company, they are more of a service company with a tech software. And it's very important when you try to evaluate the business to actually understand what exactly they're doing, what is business model exactly. Because everyone, so these days, every PE firm, every venture fund, and everyone who gives money, they want the company to become SaaS. They want the companies to charge recurring like annual subscription in one way or another. Like the last company I worked with was fintech, and fintech is literally makes money of transaction fees, right? And still all the bankers would ask you to transform it into the SaaS company, transfer it in the company which will charge recurring fees to customers. And that's why, because of these multiples, it won't be like 3x, it will be like 10x, like any day once you have such business. But yeah, for our purposes, for our exercise, I would look at enterprise value to EBITDA, and you can see that we have some sort of range here. So some companies are valued at 9x, some companies 13x, some companies 6.5x. Again, there are different reasons why there's such a big range. But for our purposes,
can I add one more thing, Elena?
Yeah.
Yeah, so in terms of valuations for SaaS companies too, the heavy emphasis on revenue is that they're growing way too quickly relative to the cost of development in the earlier years. So the EBITDA doesn't really reflect its potential. So hence the reason why the EBITDA numbers need time to catch up. So it's not as relevant as the revenue numbers.
Yeah, absolutely. Yeah, thank you for adding this, Kevin. I think that's a very important notice. Okay, so what I would do, I would just simply take average of these guys and say, oops, sorry, 9.6 is our multiple for entry, for example, right? So you can play with numbers again. Here is the cell for entering the multiple. And here is the evaluation of the company using multiple. Again, please don't take it as a correct multiple. For Zoom, it's a wrong valuation. But for the purposes of private company, that's exactly what's going to happen. This is the mechanics of valuation. You can, for example, say, hey, maybe 9x is too expensive. I think this company should be worth 8x. And you can look at the different number, right? Does anyone have questions about the enterprise value? There are formulas, basically, which are being pulled from different sheets, income statement and assumptions, and that's very good at the company. Here you can look at your returns and see if you're going to make any money on exit or you're not going to make any money on exit. But yeah, if you have time, for those who are interested, I'd really recommend looking into this other sheets and just see how all of it related and what's going to happen, right? Okay, so we don't have much time left, and I want to talk to you about the important fact, the assumptions. So we have this income statement. We have our metrics. We have revenue growth, EBITDA growth. We have gross margin, SG&A, other EBITDA, etc. So all of these allow us to analyze the company and actually predict the future, and it will help us to also to guess which multiple will be better multiple, or which will be realistic multiple for this business, right? And here we also have to, so every evaluation must be done under assumption that there are various scenarios. Like everyone knows, 2020 wasn't such a great year for, I don't know, 90% of the companies. And this is why usually when you do valuation, you create several scenarios. There are different sensitivities, which we'll not look at today, but you have to do scenarios at least. There are 3 scenarios usually: base, upside, and downside. Base one depends. This is purely up to you. To be honest, you can use any numbers which you find reasonable. Usually when you use a certain number here, you would have to justify them if you do a business case for your company. But for the sake of the time, again, just entered all the assumptions which I find appropriate. I'll try to explain to you why I chose these numbers. You will have to do this exercise for your company as well. So please ask me questions if you have any. Income statement assumptions are very easy, I believe. Or actually, no, it's wrong. They're most difficult ones, especially revenue growth assumption. This is a very difficult task. You will have to have, in a big company, you will have to have a whole data science team, which will be working only on revenue. They will be predicting volume, say sales volume. They will be predicting prices. That's a very complex task and involves lots of analytics. For our purposes, we just simply go to our past and just trying to give a reasonable, trying to guess. There is no other way to say it. So we see here that the company grew over 100% a year, then 80% a year, and here is 300%. But we know what happened, right? And that's important in any evaluation. You have to understand if there is any force which affects your company. And this is exactly what happened in 2020. Everyone just joined Zoom because of the pandemic. So this number, you will ignore it simply. And you will try to think, okay, so if there was no pandemic, how much Zoom would grow in 2020, right? I think it probably wouldn't be able to grow in 120%, but it probably would make 70%, right? And that's why I'm using 70%. But again, in real life, you will use, for large companies, like Amazon uses analytics, machine learning, and etc. to define this number. And gross margin is very simple, actually, this one. Simply because gross margin will be affected by revenue, right, and costs. And if we assume that we guessed revenue correctly, costs will grow together with revenue. So there will be very linear. There will be very linear dependency there in majority of cases. So we can assume that, okay, in 2020, gross margin was 69%. In these years, the gross margin was 81%. And you see, gross margin before was very standard, pretty much. I think that with the, I guess, larger growth, or I don't know, going forward, Zoom is a bigger company now going forward. So I assume that 69% will be their real gross margin. And correct me if I'm wrong, Kevin, but for SaaS companies, I feel like 60–70% gross margin, it's a very standard thing, right?
I think it's standard. I want at least 60% when I'm looking at tech companies.
Yeah, so knowing the market averages also gives you guys an opportunity to actually say, hey, my guess is right or my guess is wrong. So you know for sure that your gross margin will be somewhere between 60–70%, for example, right? And I want to use 69 because it was in 2020. So, and this is why I used it. So SG&A is usually pretty flat number. It will change when the company grows significantly, because simply you have to open new offices, you have to hire new people, etc., etc. But I would really be surprised if the executives were able to, say, jump from 11% to 20% here without, just without any explanation. So I just assumed that the flat. Here I assumed. Again, let me correct this. Sorry, it's a different one. It's not corrected. So okay. So yeah, so this will be flat number, and you just can go ahead with it, right? For other, the same. I would assume it's a pretty standard number. So I doubt it will be different that much. Oh, I think I confused. Oh, yes, I think I confused these two guys. Okay. And the balance sheet then assumptions. So remember I told you earlier that net working capital is very important. Usually when you value the company, you want to know what net working capital is, because there will be no cash when you buy a company. Post-closing will be always zero. Unless you buy a huge public company, but usually what you're gonna buy, will be zero. And this is, but the business carries on. You need to pay to vendors, you need to pay salaries, you need to pay, I don't know, some rent, etc., etc. And this is why you need to have some money. And usually when you offer a price for the company, you tell them, hey, my price doesn't include net working capital. So you have to live in the company. You tell them that I want in the company, for example, $60,000, right? Or $60 million in this case. You tell them what you want to stay. And to understand what you need for the company to stay alive, you actually have to calculate this number, right? And in this case, again, you see how much Zoom changed within literally 3 years. It's insane how company changed. How company went from minus $25 million in revenue to over $600 million in revenue. Like literally, this is crazy. An interesting fact I want to talk to you about. So usually net working capital is calculated as current assets minus current liabilities. But for SaaS companies in particular, there is an important item which will change the situation. And this item is deferred revenue. People have different opinions on how to calculate this, whether to include this item into calculation or not. I personally, I think it depends on situation, right? So in this case, we included deferred revenue, but you see what's happening to net working capital? It simply becomes like, well, I guess, okay, so I guess we have, it's a bad example because the company has a lot of assets. But yeah, so if you remove this number, your net working capital will be even better, right? So if you, in small companies, what happens, and it will happen in your company, so please pay attention if you can. I know it's been a while. So for many companies don't have that much assets as Zoom does, but they have different revenues. And in the company you're gonna work with, I believe their deferred revenue represent a large number, or maybe it's a different company, but anyhow, so if deferred revenues is a very large number, but you don't have that much current assets, your net working capital will be negative. And net working capital can be either positive or negative, and negative may mean two things. If you don't have deferred revenues, then negative working capital means that your company doesn't have enough assets to cover its liabilities. If, for example, you had to pay all of these bills right now for some reason, right? But if you have a high deferred revenue and you have net working capital, in this case, you actually, it's a good thing for you because deferred revenue, it's simply the cash that you have now, but you have to perform service later. So that's the big thing to look out for when you value this sort of companies. Because even if you have negative number, it may mean different things. And that's why some people like to include deferred revenue and some people don't because of this impact on net working capital. What I'm trying to tell you guys, so even if you have numbers that are calculated automatically, you really need to understand what they mean. You really need to understand what items they're made of. So you're able to say, hey, it's a negative number, but is it actually a good thing or a bad thing, right? Because it can mean both. And okay, coming back to assumptions, sorry for distraction, but we have not much time left. Yeah, so balance sheet is also like income statement. The forecast is made based on the drivers or metrics, whatever you call it. And here is pretty standard. Accounts receivable days, 41. We simply take the last one they had. It looks like they improved significantly their collection. You see, it used to be 70 days, and now they collect their money in 41 days, which is very great for the company. They get the cash faster. I just simply used the 2020 date, sorry, as the base assumption. I assumed the same is going to happen in the next year, right? And for upside case is a better case. So for example, we say here, hey, the company is going to grow not at 70%, but at 100%. And gross margin will be not 69, but 70%. With gross margin, it will not change significantly unless you really change business model, because costs are growing. The costs are growing together with the sales, so you probably will not have much room for improvement usually. Okay, so here, for example, we can say that, okay, I think it's not fixed, 20%, and this will stay at the same level. Oh, no, okay, sorry guys. Okay, this will be slightly better, 11%, and this will stay at the same level. Again, okay. We can say here that we'll have better receivables days, or can pay longer to our vendors, which is also great for us. Yeah, so let me show you what's going to change. So for For scenario 1, we assume we're going to grow 70% growth rate, and our exit valuation is $64 billion. If we use scenario 2, our exit valuation will jump to $170 billion, right? If we use scenario 3, our valuation will be lower than first one valuation. It will be $30 billion. So here you can play around just by using scenario. You will see different valuations, and often you will have to run those. We actually will have to run those scenarios to see how much money you can offer to the company. That will be another item which you look at when you're gonna value the company. I think we run out of time. So there is a completed file, guys, which you can look at. It will have everything together. And oh, okay, last item, super important because you'll have to do that as well, I think. So you can assume that you're gonna pay $6 billion for this company. So we can say that the ratio of debt to equity will be 2 billion debt and 6 billion in new equity. If you're gonna add here numbers, you're gonna have everything completed here. So, and you will see the company evaluation as well over here, and you will see how it changes in terms of equity value when you use debt. And you can play around with these numbers as well. So you can say, hey, here is 1 million, here is 7 million, and you will see again how it will affect your valuation, how it will affect your returns. Over here, you can look at returns. Does anyone have any questions so far? Because I think we need to wrap it up.
I do have a question. Let's say you're working on a team and then you both have different assumptions. So how do you decide which assumption to go with?
That's a great one, actually. It depends on your negotiation skills, or I guess your influence skills. You will definitely brainstorm, and both of you would have, so for this number, you will definitely have data science research, right? And if you work in investment banking or a PE fund or VC fund, they get from bankers like this much of reports on the market and companies and transactions every day. So you will have some supporting information to support your basis, right? But to be honest, I will not lie, in many cases, people just assume something based on their intuition, and you develop intuition after a certain number of transactions, right? You just know what number will be there. And often people just use this information on research just to confirm their assumptions, because everyone wants to claim that I made my decision not based on my intuition, but based on my data. And that's what you want to say, hey, this is data, this and that. But it will be mostly regarding, I guess, revenue growth. You would also compare with industry data, right? So you will look at your competitors. And that's why I said, like, if you're, for example, trying to compete with Google, right? You will definitely look at Google's metrics, like growth rate. You will look at Google's EBITDA. You will look at Google's SG&A percentage. You will calculate it based on their financials, which are public, right? And actually, I think this company calculates their percentage as well. And what's interesting, actually, when I looked at Microsoft and Google yesterday, they have very similar valuations. And the funny, I guess, what I found funny was that they even had similar cash balance, which is very interesting. Remember, I told you that the companies are being might end up being a target when they have certain number of cash on their balance sheet. And the same story, what Kevin asked, the company, how much cash should you have? What is the good number, right? So I guess comparing your own cash balance to Google's cash balance is a good threshold to tell your shareholders and say, hey, you know, they keep this money, we want to keep the same money. So you always compare with your peers, you always compare with the industry, and try to make sure that your company performs in a similar way. So if your company, for example, has here, so for example, if here we have say 50% gross margin, right, for the year 2020, but everyone, you know that industry standard is 60 to 70%. You want to investigate actually and see why in this year you have 50% only. That's where the whole, I think, knowledge comes in or research comes in, because it's very, you see, we just plugged in some numbers, right? And everything is calculated. But yeah, the main job of investment banking analyst is to understand, okay, why is it 69%? What happened here? Because for me, it's interesting, for example, to look at these two numbers and understand why, even though we grew how much, 4 times in 1 year, and you see our COGS actually also, they didn't grow that much. Why our margin dropped so much? Why it got reduced by over 10%? And this is something you would investigate and discuss with people. Again, who's going to be right? I don't know. In investment banking, I assume the manager will be right. But yeah, it's good to understand what was the basis for your assumption. Absolutely, yeah.
And this is where it's like really helpful to have a diverse team. So oftentimes, if someone has more expertise in certain area or certain industry experience, it really helps. And then talking to industry experts, like if you're doing, you know, an M&A deal, or if you have different investors that you're sharing the financials with, certain investors might have different experiences and stuff like that. But going back to Elena's point, if it's like just very big publicly traded companies, you know, oftentimes I would assume, right, the boss or the biggest title in the room would probably have a little bit more sway than others.
But yeah, but you definitely have to have your own opinion, and you definitely should try to push it as much as you can, because you know, like how to say, it's buying a company is such a bet. 75% of acquisition fails, right? So for you, it will be a great chance to actually test your knowledge once the, I don't know, like 3 years have passed or something like that, right? Then you can see, hey, was I right? Was I wrong? Why was I right? Why was I wrong? And you, at least you can learn from that for sure. Yeah, I think that's it for us. If you guys have any questions, please ask. Or you can, I don't know, like, Kevin, do you have a practice when they can write some questions a bit later?
Yeah. So, you know, there's a Slack channel, but, you know, we're going to do some, you know, financial modeling as a homework assignment. So these are one of those things where, like, the more you do, the more comfortable
Yeah, absolutely.
you get with. Yeah, you can stick around just for a few minutes for any additional questions, but I think that's a wrap for today. Let's give Elena a round of applause. Thank you so much for preparing for this lecture, everything. Thank you.
Thank you. Thank you.
Great. Well, class is dismissed. You know, you guys are weekend warriors. Well done. And I look forward to seeing you guys next week.
Yeah. Have a nice weekend, everyone. Bye-bye.
Thank you
Thank you.
again.
Have a good weekend.